prediction as well as the trading positions will be much better than what I was able to produce in this research. So what I have done, as I mentioned, that I looked at information content of option market activities. One of the variables in the option market activities is called open interest. Open interest is the sum of the total open positions as of today on each strike price on each maturity. That's called open interest. Okay, and Chicago Board of Option Exchange updates that information on a daily basis, as people are doing a lot of buying and selling every day. At the end of the day, Chicago Board of Option Exchange will update that number. So when I see accumulated number of open interest on a certain strike price on a certain day, then it gives me an indication of people's behavior, what people think they're betting on, okay, where they think the stock price will go. So that kind of information you can predict or infer from this data set. So using one specific maturity date, I look at the open interest distribution across the different strike and use them as a relative frequency to develop a weighted average value for the stock price. Okay, so I came up with a predicted value of the stock price today, 1 month from now. So basically, I'm saying based on as of now information available in the open interest on 1 month maturity options, my model or the distribution of the open interest indicates that stock will close X dollar in 1 month from now. So I'm making a forecast almost like 30 days ahead of time. Then I do 7 days later, I go and recalculate the predicted value, okay, based on further activities that happen in the next 7 days. And I also do it another one 14 days later, 21 days later. So I do a 3-point estimate in a 4 weeks time period of each option month. Okay. And now I know, and this is what I intend to do with the new database, and do some sort of back testing with the model to see that instead of doing this static point-based forecasting, what if I continue this forecasting using Bayesian learning methods and see whether this predicted calculations gives me much better accuracy of my forecast value. Okay. Because on the third Friday of the month, option month, the closing stock price, okay, and my predicted stock price, if it is almost equal, very close, let's say within 1% or 2% boundary, then I consider that it's a very good prediction, a very close prediction. But if it is way off, let's say it was off like 5% or 10%, then you say that your level of accuracy is low. So to give you a heads up, what I was able to generate from my research in there is that the accuracy level of my prediction was more than 72%. Okay, and then in order to test my forecast accuracy, I took a fresh data, okay, of future 3 months, and using the same strategy, looking at forward-looking data, I taken position ahead of time, example position, okay, and I wanted to see whether my strategy made profit or loss. And then when I did that calculation using various different investment strategies, stock only strategy, stock and option strategies, collar strategies, covered call strategies, protected put strategies, short selling strategies, different strategies I implemented, I have observed that each and every one of my strategies were doing better than simple buy and hold strategies. In addition, I was able to also show that the strategy-based portfolio performance was better than S&P 500 buy and hold portfolio. Okay, so that is what, in a nutshell, my research paper was, and again, what is the future direction that I am looking at in the future. Okay, so let me read a couple of sentences so you can see. So in this paper, we use daily closing data on Chicago Board of Option Exchange options of 30 stocks during the month of February through July of 1999 to investigate whether options open interest contains information that can be used for trading purposes. Individual stock price at option maturity is first predicted based upon the distribution of options open interest. Summary stop and leave.
Excuse me, sir. It
Yes,
seems you are reading from somewhere, but I think we cannot see on the screen anything. It's a Word document, blank Word document.
let me see if I can enhance the size. Just a second. Let me see if I can enhance the size. Where do I go?
No, it's not about size. I think because the screen is white. I mean, the Word document is a plain Word document. So no let.
Okay.
We could
Let me
not
see.
see the.
Maybe I haven't shared that page yet. Where am I?
Maybe another screen. Yeah.
Yes, you are right. I did not change the page. Share content. And now I am doing, I believe, this page. Can you see this now?
Yes, sir. Now it's fine.
Can you see a new page? Okay. Thank you.
Yeah.
Thank you. Yeah, I forgot to change the share, the new documents. Okay. So here I was reading from the abstract that I'm creating a set of predicted values of the stocks. I use 30 stocks, okay, using the distribution of the open interest, options open interest. And then I created several strategies. Strategy one, stock only portfolio, stock plus option portfolio, and we are doing some directional trading strategies that are then considered after comparing the predicted stock price on the maturity date. Okay. In our sample, these trading strategies generate better returns compared to the S&P 500, the buy and hold strategies. Okay. So Martin et al. 1978 only looked at the benefits of covered call strategies and indicated that investors can benefit and enhance their portfolio return. And here I indicated much more than that. I said that you can take the information content from the options market and create different appropriate strategies, not only just a simple cover strategies, and you can improve the portfolio return. So our empirical evidence indicates that non-price measures of the activity in the derivatives market, such as open interest, contain information about the future level of the underlying asset. This lends support to the work of Copeland and Galal, S. O'Hara of 1998, that suggests that the derivatives cannot be considered redundant in a market with information-related frictions. Okay. One implication is that the distribution of non-price derivatives market activity may be helpful for other purposes, where the physical instead of the risk-neutral distribution of the underlying asset is needed. These include beta estimation, volatility forecasting, volatility trading, and also different kind of portfolio measures. So now let me take you to the model. Okay, I don't want to. I will make these readings available to you. If anybody is interested, just send me an email, and I'll send you this paper for you to read. But let me just jump to the distribution of the prediction model so you can see what I'm talking about and how it can be improved to the Bayesian model. So here, I said consider an equity instrument, in other words, stock, that has a set of call options and put options maturing at time t, and the current time is, let's say, t0. Let the price of the stock is ST, and let the XI of T is the set of strike prices on call option, and XP is the set of the strikes of the put option. Because for every maturity, remember, there are both call options and as well as the put options. The payoff at maturity to the buyer of a call option strike price is defined as this profit function, okay, maximum of 0 or xt minus x, and the payoff for the put option is maximum of 0 or xp minus st. And then I developed this. Let me go to my distribution table. So in this paper, we propose by conjecture and not by proof that the distribution of the net open interest at time t over the range of the tradable strike prices for options maturing at time capital T be used as a proxy for the consensus physical distribution for the stock price. Okay, so I made a couple of definitions. Definition number one is COP. In other words, call option open interest based predictor. So I call that first in order to calculate the option indicator, the predicted value. Okay, I take the sum of the exercise price multiplied by their distribution of the open interest. So how did I calculate that QIT? Is the sum of the open interest of the call of particular strike price divided by sum of the total open interest. So if let's say there are three strikes, X1, X2, and X3, then I will have open interest for O1, O2, and O3. So first I calculate Q1, which would be O1 of C divided by total OC. Then I use that one to multiply with the strike price, plus X2 times Q2, plus X3 times Q3. That's what it implies. Okay, weights are calculated based on the open interest distribution, and then multiply that with the respective strike prices. So this weight, QIT, kind of like is a proxy of a probability measures. Okay, but very simple measures. Looking at the total activities. Okay, we created the relative frequency, and that serves as the proxy for the probability. So it's like a probability 1 times exercise 1, probability 2 times exercise 2, plus probability 3 times exercise 3, and so on. So this way, our first prediction was on call option based predictor. So similarly, we do it for put option based predictor. Okay, so this one is for the put market, and then we do it together. Both call and put together, we find that weighted average of those both call and put option predictor. So there are three prediction values, predicted values: call option based predicted values, put option based predicted values, and overall call and put option based predicted values. And from that, once we calculate three different predicted values, I believe in my research, I only took the overall weighted average open interest based predictor as my indicator or predicted value. I then compare this one with the actual stock price on the respective days. So here I talked about the data distribution, where I took the data, what industry they belong, and then I developed a couple of strategies. Okay. And in different strategies, I apply the same dollar amount as in investments. Okay, $10,000 is going to be invested in each strategies. Okay, no more than that, no less than that in any of those strategies. And then based on each strategy, I will calculate their respective profit. Okay. So let me go to the trading strategies. Here are the different trading strategies. Number one, passive buy and hold strategy, meaning we simply buy the stock and hold it until the maturity date with stock only. Okay, this is kind of like our benchmark portfolio return. We compare the portfolio, our other portfolio return. We want to prove that other type of portfolio return is going to be better than the passive buy and hold strategies. And here is our definition of the profits, how we calculate that. So we buy the stock price at S small t and sell it at a S capital T. So again, of course, S capital T is the maturity date and the number of shares. And then we subtract our investment amount, which is $10,000. Okay, and that gives us our profits. And then you can convert the profit into a percentage. Then we take the Martin's passive covered call strategy, because we wanted to prove that even though Martin's covered call strategy established that it will enhance the portfolio return, we wanted to show that our portfolio return will do even better than Martin's portfolio strategy. Okay, so we take one of those Martin's portfolio strategies, apply $10,000, and take a position. And based upon their model, we calculated their portfolio using this equation number 3. Okay, we calculated how much profits or loss this particular covered call basic strategy is going to generate. Then we go to our open interest based active strategy. Okay, again we do it for stock only first. Why we are doing the stock only? Here, if our open interest based predictor is greater than the current stock price, then we anticipate that the stock will go up. Then we take a long position on the stock. On the other hand, if our open interest based predictor price is lower than the current stock price, then we anticipate that in the future stock will go down. In that case, we will take a short position. So our stock only portfolio position can have both long and put, long and short, depending on the forecast price versus the current stock price. And then we create one called open interest based active strategy, stock plus options. So in that strategy, we have 4 different sub-strategies, if you want to call it. What we did, if the indicator signals a minor upward movement in the stock, then we design our one strategy, we call it ASP1. If the price indicator signals a major upward movement in the stock, then we call that strategy as an ASP2. The price indicator signals a minor downward movement, we call it ASP3. And the price indicator signals a major downward movement, then we call that strategy as an ASP4. Okay, and we define what we did as a result of each of those strategies. Okay, so the price predictor indicates a minor upside. Our investor buy the stock price at the market and then initiate a call option writing. The strike price of the written call option is chosen based upon the upside potential indicated by the strike price predictor and the availability of the strike price, depending on what the strike price is available around our prediction. And then we calculate our profit function for our covered call position according to equation number 8. And then each of the other 3 are also, if it is a major upward movement, then we take a buy position on the stock and we sell a deep out of the money call option. Okay, that's one of our ASP2 as a portfolio strategy. Here is our profit function calculated in equation number 12. And then ASP3. Okay, for a downside, we take a short position on the stock and or we buy the stock and then buy a put option. Okay, and then if it is a major downward movement of the stock, Then let me see what we did. Maturity. So our investor will write a cover call at the strike price close to the predicted on the maturity date and buy a put option. So it's a collar. Okay. In a major downward signal, we applied the collar strategy. This is also known as a collar strategy. And the return of the collar strategy is shown in equation number 18. And rate of return goes all the way up to equation number 20. So these are our different kinds of strategies, if you want to call it, right? And then we provide in a tabular form the results of our portfolio. So let me go to the table so I can show you in terms of percentages how we did compared to the different alternatives. Where is the table? Just a second. Sample table. Sample and farms names. Here is our first table. This is the table, individual stock performance of the buy and hold and stock only active strategy. Our strategy, which is AS, active strategy, and buy and hold, is the strategy for the benchmark that we are going to compare with. And as you can see, rate of return for each of those different strategies are presented. And I believe you can see here that our option-based strategies, the rate of return was 0.86 higher than simple buy-in strategy and other strategies. Okay, so our strategy-based portfolio did well, okay, compared to the other alternative strategies. Then here are the different option month forward-looking forecasting numbers. You can see that for example, if you look at this table, actual up percentage, actual down percentage, what I have presented here on those different months, that when I predicted the stock will go up in February, 31%, 53% in March, 30% in April, and 35% in May, it happened. So our accuracy wasn't really that great when we made an upward prediction. But when we made a downward prediction, it was relatively much better. 59% in February, 47% in March, 70% in April, 65% in May. We were accurate. We were correct. Okay. So this table indicates some of those percentage reflection. Then in June, okay, we were correct for the up 77%. In July, 63%. But on the down market, 23% accuracy and 37% accuracy in June and July, respectively. So here we put everything together as our correct up prediction versus actual prediction. We correctly predicted upward movement. It was 77%. We were correct. Okay, in June, 87% we were correct in July. We correctly predicted downward movement, 24% accuracy in June, 56% accuracy in July. And similarly, also in February, March, April, and May, our correct up movement accuracy was 67%, 50%, 54%, 55%. For correct down movement, for February 60%, March 45%, April 80%, and May 81%. And I'll tell you, because I am the one who processed the data all the way in calculations, sometimes my prediction error was as a result of only, let's say, 25 cents difference. Okay, I predicted that it will go up by this much, but it was dropped by 25 cents difference. So my inaccuracy level in certain cases was marginally small. And I felt at the time that point estimate that I have done only on a for specific days. Maybe I should have done that one on a continuous basis, everyday basis. So for that, I know that the Bayesian methods is the only way that this prediction model can be improved. And then, as I said, I already have the database. I collected the data from 2006 all the way up to 2018, 19. So I have a very recent database, large database for many stocks. Um, and it is possible to do this data mining or data analysis and do some of those back testing of those different strategies. And once we can come up with certain strategies that can improve our performance at the same time accuracy level, then I can go and test them on the real data on the stock market, okay, for next few months, and then use that as a part of our, performance evaluation strategies. Okay, so with that, I'm going to stop here. And again, as I mentioned, I will make this paper available to every one of you who are interested in reading this paper, and then dig further through this one. We can do Zoom conference call to go over with this on different technicalities of this paper. Okay, I wanted to share with you another thing. Uh, let me see if I can share here. Here, this is a sample stock for which I have collected data. Let's say this is May 22, 2020, last year's data. So as you can see in the data set, the way the data is presented is call side on the left and the put side on the right. And on the middle side, this is the strike price. Okay. This is about a company named NVIDIA, okay? And these are the different strike prices available for May 22 for one option month. Look at how many strikes are there. It started from 130 and then 135, 140, all the way to 380. So there are so many different strikes, okay? And then I looked at the open interest column. Look at here. This is the open interest column on the put side. This is the open interest column on the call side. Okay. I look at the distribution of this open interest along with the strike prices, and then do the calculation for a call predictor, then a put predictor, and then a combined weighted average predictor. That's how data are being processed and analyzed. Okay. Let me share with you another file where I did a simple exercise with Excel. Where is that Excel file? I probably did not open that data. So, okay, I probably didn't open that data. There was another file available where I did a simple exercise that probably I could have showed you. But anyway, I can further engage with conversations with some of you or any of you. Either you contact Dr. Ranjit Singh, and then all of us can engage in Bayesian learning or machine learning, if you want to call it, some kind of forecasting methods that we need to develop. And once a new method is implemented, we have the database to backtest and then develop some strategies. And from there, we can create a couple of papers. One simply to replicate Martin's paper. Another one would be to replicate my paper along with other different kind of strategies to develop portfolio performance type of papers based on US market. And then we can also collect some data from the Indian options market and then we can try some strategies. Once we develop some of those strategies, then we can implement that to other markets. Okay. So with that, I'm going to stop here. I like to open the floor if anybody has any questions right now.